Arvind, good morning. Thanks so much for waiting by patiently as well. Um, in a manner of speaking, a few people might be surprised with the confidence exhibited by the Fed in its statement about the US economy. My question is, what does that do to emerging market trades? Because everybody was working with no Fed rate hike in December. Now there is probably a 50-50 chance.
Well, I mean, if you look at the statistics from the markets as of yesterday, the market was forecasting a 35% probability of Fed rate hike in December. That probability has gone up substantially after today's statement. I think it's now closer to 50-50 or maybe even a little higher. But so I think in general, emerging markets investors are going to have a little bit of adjustment to do, that the Fed rate hike is on the corner. But my belief is that by the time we get to the rate hike, it is like one of the central bankers said at the recent IMF meeting, get it over with already. We are all been hearing about it for so long. We in the emerging markets are sick and tired of hearing about it. We're ready to have it happen and have put it behind us. And I think that's the same thing that equity investors are going to come to the conclusion sooner rather than later, that the Fed rate hike has been dangling out there as a risk for so long that at some point you want to get it over with. And I think it might cause a little bit of a short-term concern on emerging markets. The reality is emerging markets performance is not going to be Fed rate hike is not the make or break of emerging markets. It may cause short-term underperformance, but I don't think it changes the long-term trajectory.
Yeah, patience seems to be running out. Arvind, hi, good morning. Whenever the Fed rate hike comes in, do you think it could be potentially a big headwind for countries or emerging markets like India? Or do you think it's not going to be such a big event purely because, the Fed has taken so much time, the markets have had enough time to digest the news bit?
I think it's clearly the latter. I think it's clearly that this thing has been dangling out there for so long and has been a risk for so long that investors have adjusted to it. So I think what is likely is that the Fed does one rate hike and comes out with a statement which promises a much more circumspect wait and watch, look to see the effect, look at global turmoil, if any, look at other factors to determine when the next rate hike will be. So it'll be, let's get the first one on the table, but after that, we're going to be very slow to go. And I think as a result, emerging markets investors will realize that the Fed rate hike is not the biggest challenge for them in 2016. It's going to be, how is their growth looking? What are the drivers of that growth, and how sustainable is that? And therefore, there's plenty of liquidity that is going to be probably what ECB and the Fed hikes rate. So there's other offsetting factors to a Fed rate hike in terms of global liquidity too.
Arvind, the other big trend which perhaps could be a crucial trend for 2016 is that sovereign money now seems to be drying up. World's biggest sovereign fund last night has reported a loss after a gap of 4 years. There is intense pressure on other sovereign funds also, largely from Middle East, to reduce their exposure to other major assets. Could that be a concern area for 2016 and beyond, that if the sovereign money dries up, what happens to cheap liquidity?
Well, I mean, you have to be careful what you wish for. The way that the sovereign money will not dry up is if oil prices go up sharply. And frankly, from a country like India's standpoint, you'd rather have a little bit less money with the sovereigns, which are oil-driven, lower oil price, than vice versa. So, the sovereign wealth funds that are suffering, whether it's Norway or it's Saudi, which is selling assets, are partly because oil prices are so low that they can't, meet their budgets and not have to run a deficit and to liquidate some of their portfolio. So I think that in a sense, yes, it is a somewhat negative factor for global liquidity, but it is a much bigger positive factor for many countries which are oil importers. So therefore, on balance, I think for a country like India, it's clearly a positive.
Arvind, move the center of discussion from US Fed and back to India. Now, I distinctly remember last time when I interacted with you, you made a point that India was the biggest beneficiary of drop in oil, and you were looking to buy into Indian stocks on every decline. Well, the decline has come and gone. What's been your portfolio strategy?
Well, we have bought some positions in individual stocks. I've always emphasized one point, that India is a country in which we look at a lot of bottom-up stories and not a big macro call. Frankly, the macro call, India has done okay, but it's been disappointing in terms of the macro earnings growth numbers for individual companies. So we've bought individual companies where we think there are good opportunities, but we've actually gone a little slower than I would have otherwise anticipated, because I have gotten somewhat more constructive on oil prices. Now, I don't know precisely whether that's going to happen in 3 months or 6 months or 9 months. It's hard to time, when the big move in oil comes, but I think it's sooner rather than later, and I think oil is headed back to, at least $65, $70 over some period of time, and as that happens, India, one of the things that I've come to realize more and more as I talk to investors and other participants in the Indian market, India is one of the consensus beneficiaries of low oil prices, where people are using this as a place to invest. And if that low oil price story ends, I don't think the Indian growth story ends. I don't think the Indian growth is significantly or much affected if oil goes to 65, 70. That's easily digestible. But some of the, dare I say, hot money that is sitting in India on a low oil price beneficiary play might leave. So that'll create, I think, some buying opportunities. But that's not something that we're sitting around waiting for. We're selectively buying, but we are also keeping an eye on oil prices to make sure we don't get surprised by that as a potential short-term negative headwind for India, not a fundamental, but a trading headwind.
Wow, that's an important point to look out for, really. So, I mean, Arvind, how soon can this reversal in oil prices come around? I know it's a really tricky one. No one knows, not while it was slipping down, while it went up, as to which way it's going to head. But how soon, and more importantly, what conditions do you think are going to sort of make oil prices reverse the trend?
Well, I mean, there's one very simple fact that gets almost no attention, which is the fact that if you look at the gap between supply and demand, that was widening in 2014 and first half of 2015. In the last 3 or 4 months, the gap between supply and demand has started to narrow. Now, the bears will tell you that the supply-demand imbalance will not end till the end of 2016. But I think what the bears are forgetting is as the second derivative that is most important, the change in that, and the fact that the two lines have started to move towards each other, the supply and demand, even if they don't cross for another 4 or 5 quarters, suggests that sometime in the next quarter or two, and it could happen sooner rather than later, the market's going to wake up to the fact that supply demand is no longer getting worse, it is getting better, and even though inventories are high, as those get chewed up. So I think there's a couple of things. Iran coming back is a big fear. I think the Iranian production is going to prove to be much smaller incrementally right away than people are expecting. It may be only 300,000 to 500,000 barrels a day, not a million barrels. So I think there are 1 or 2, I should say, bumps that the market is over concerned about. And the fundamental reality is that U.S. production is falling, and other parts of the world production should start to fall in 2016 because of lack of investment. And all of that sets up, for me, 2016 to be a year where oil is going to be one of the best performing, oil sector and oil equities could be amongst the best performing equities on a global basis. And frankly, India is not a place where you come to buy oil companies. So India is going to have somewhat of a headwind if my forecast turns out to be right.
Arvind, frankly, the earnings season so far has not been very inspirational, and now the disappointments are coming from the big ones: TCS, Infosys, Lupin, Asian Paints. So it's not the mid-cap end of the market; it's the large cap and the more efficient end of the market which has come out with set of numbers.
Yes, I mean, I think it is disappointing, and I think this is the 3rd quarter in a row where earnings have been not just sluggish, but somewhat disappointing. So I think one of the biggest frustrations in getting too excited about India is we can make all the macro, fairy tales that we want about how great India is and how well positioned it is in a period of low inflation, low commodity prices, central bank willing to and now, or able to and now willing to cut rates. All of those are positives. But when it comes down to the bottom line of earnings, we're still not able to get earnings momentum going. So I think that has been one of the biggest frustrations, is that local conditions are not providing the kind of earnings growth that we would have hoped. And I guess we can always hope that the next quarter will be better. But I think there are a few signs of life. I mean, I think the road sector, some of the companies that are involved in that will certainly be showing some good backlog growth, some good new order growth, and hopefully in a quarter or two, good profit growth. And I think maybe some other sectors will gradually show life. Obviously, we've seen some of the commercial vehicle companies showing good numbers. But the cement sector remains disappointing. Auto, I think Maruti was fine. So there are a few areas where there are some green shoots, if you will. But frankly, it's becoming frustrating that some of the major sectors like banking, when you have an Axis Bank, have the kind of bad debt recognition that suggests that we haven't yet plumbed the bottom in terms of the bad debt cycle, and that's frankly one of the things that is not necessarily a leading indicator, but you would like to see some economic leading indicators would suggest that the bad debt cycle is only a quarter or two away from turning around, and we don't have enough evidence of that yet, and so we're looking for some more signposts to get much more convincingly bulled up about the overall Indian market.
Right. Arvind, for the longest time, you've liked private banks. You mentioned Axis Bank. ICICI Bank also of late has not delivered. They have a large exposure to the power sector. They have a large exposure to the infrastructure sector. So with the exception of HDFC Bank, frankly, there are concerns. There are fault lines within the private banks as well. Now, private banks are crowded. Every foreign investor, they love to own private banks. So do you think somewhere private banks will suffer and they could underperform purely because they are crowded?
I think that is certainly a risk. I mean, we like one or two private banks, but we also like some of the NBFCs. And again, some of the NBFCs like Shriram Transport have struggled, but other NBFCs in the housing finance space have done well. So again, I mean, I think it becomes more of a stock picking a specific company or a specific subsector where, that includes the financial institutions where things are going well. But you're right that Axis Bank has been one of the darlings of FIs, and therefore this one was a particularly disappointing shock. ICICI Bank has been less favored and has been a huge laggard. So that one is not one that's going to shake up banking investors' resolve, but Axis Bank certainly creates the risk that the banking sector could come under some profit taking. But my view is that for some of these private sector banks, the bad debt cycle, which is coming from which first came from infrastructure, and now there's some leftover from whether it's power-related infrastructure or it is metals-related companies. There may be a little more to go, but I think, in terms of the bad debt cycle, I still think we're much closer to the end, and therefore I don't think there's more than a trading sell-off that fundamentally could raise questions about the health of the private sector banks. I think the private sector banks are okay. They just need economic growth to help them grow their loan book more meaningfully.
Well, one does hope they grow. It's a large weightage on the index, Arvind, but understand we have overstayed our appointment with you. It must be late. Thanks so much for taking the time out and staying up and talking to us today.
Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at ET Now Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ET Now.